Before you dive into selecting your benefits, you'll want to become familiar with the difference between LTD, STD, SDI, and pre-disability because you will need to understand which ones will apply to you.
All right. Today we are looking at group disability insurance, and I am talking about short-term disability, also known as STD, long-term disability, also known as LTD, and state disability insurance, also known as SDI. Hi, my name is Mel DeWeese. I've been working in insurance and HR for over 20 years, and I've worked with hundreds of employers from all different types of industries and sizes. I want to review a disclaimer and remind you that I am not your broker. I'm not your attorney. This is not legal advice. I'm not a financial advisor. This is meant to be for educational and entertainment purposes only. Viewer discretion is advised. So let's get into it. All right. What are the types of coverages we're going to go over today? There's short-term disability, long-term disability, and state disability insurance, or SDI. I have to tell you, the first time my mother heard me talking about STD insurance, as I was telling her about my big girl job and all the important things I was doing as a young 20-something-year-old, she had this look of bewilderment on her face, and it took me a moment to realize that she thought I was talking about sexually transmitted diseases. She thought that I was referring to insurance, and she goes, "Oh, they have insurance for that?" Amazing. The topic is just so dry, but it is so important. Let me just tell you how important disability insurance is. It does not sound fun. It is not something that any employee wants to talk about, or anybody really wants to talk about it. But the idea is, and I've heard other people describe it as paycheck insurance. To explain to employees exactly what is insuring your paycheck. God forbid somebody goes out on disability and they are not able to perform their duties of their occupation. And we'll get into the different definitions of disability and whether it's ONOC or ENEOC and all that fun stuff. But for the most part, the intention of disability insurance is if you are unable to work, that you get a portion of your paycheck regardless of whether or not you can work. Many professionals describe this as paycheck insurance. And I found that to be useful when speaking with employees directly. Now, most likely, if you're watching this video, you're probably HR, CEO, CFO, and you're trying to figure out if this is something you should offer to your employees, if you're offering enough, or just to learn more about it. I have to be honest, I have sat down with dozens of insurance reps over the years to gain understanding as to how these all work. And every carrier is a little different, and every carrier, they do have their specialties. Some carriers specialize in attorneys and law firms, and others specialize in the medical industry. And those two industries are very specialized. A lot of people think of them just as purely white collar. However, they can have higher claims for disability because there was a little bit of gray area fraud going on for a while. Not to say it doesn't happen anymore, but insurance companies have gotten better at discovering it and tracking it. And of course, the first step is awareness. Because back in the 80s and 90s, a lot of insurance companies weren't even aware that this was a thing. So there were quite a few rings, white collar crime kind of rings, where mafia or somebody would be hiring all these doctors and they would be writing all these disabilities and turning it in to insurance companies and getting checks for disability checks. And likewise, attorneys, because they do know the law, they can sidestep and manipulate things a little bit. No offense to any attorneys out there, but if you are an attorney, I'm sure you know of other attorneys that may use their knowledge for things that are gray area. It's not necessarily illegal, but may not be the intention of the policy. That was an area of concern for a while, not as much anymore, but there are carriers that specialize in medical professionals and attorneys. Of course, there's other insurance companies that specialize more in the blue collar and the gray collar and all the other types of industries. What is short-term disability? What is long-term disability? And what is state disability? Short-term disability is meant to be for that first year. What are you going to do in the first year of a disability? These typically replace anywhere from 60 to 70% of an employee's or a insured's pre-disability income. And the long-term disability is meant to be more long-term. It's meant to keep you going until your Social Security normal retirement age or until you turn 65. State disability tends to be more short-term. These plans tend to look, act, and feel more like a short-term disability plan. And it is mandatory in states like California, New York, New Jersey, Hawaii, Rhode Island. What is PR? What is it? Puerto Rico. I don't have any clients in Puerto Rico, so I wouldn't know, but abbreviated as PR. I didn't know what PR was. What state is that? In Puerto Rico, providing short-term wage replacement for injury, illness, or pregnancy. All right, and that's usually what is defined as a disability. You are unable to work due to an accident or an injury, illness, or pregnancy. How long do all of these last usually, and how do they work together? Well, short-term disability typically lasts anywhere from 9 weeks to 52 weeks, that first year, 52 weeks in a year. And long-term disability can last typically 2 years, 5 years, 10 years to age 65 or Social Security normal retirement age. SDI is state disability and it's funded through taxes. It typically lasts anywhere from 26 weeks to 52 weeks. So anywhere from 6 months to 12 months, a half a year to an entire year. How coverage works. And I have this cute little chart here where what does it cover, what's not covered, and what are the general percentages that are covered under each of these categories. So short-term disability, it does cover non-work injuries, illness, pregnancy, and some mental health. LTD covers ongoing illness, disability after STD ends, and major health setbacks. Plans can cover work-related or non-work-related injuries. And the contract can be designed to where it doesn't matter. It's an injury is an injury, whether it's work-related or not. SDI, state disability, same as STD, so it's the same idea as short-term disability. It's meant to be for a shorter amount of time, 6 months or 12 months. And that's because typically most disabilities, most injuries, most illnesses, when people are unable to work, last 6 to 12 months. It's going to cover most people for most things. Same as, so SDI is similar to short-term disability, but the duration and payment is by the state that has the coverage. What is not covered? Work injuries, usually workers' comp, elective treatments, criminal activity. Those aren't going to be covered. SDI, same with state disability, work-related injuries would not be covered, and non-medical events would not be covered. Most of these plans cover anywhere from 50% to 66 and 2/3, 70%. Some of these states are covering 90% of pre-disability earnings. In my experience, as I explain these benefits to employees, when an employee sees that they're going to be getting 60% of their pre-disability earnings, they're like, yay, because most Americans are living paycheck to paycheck, and 60% of your paycheck is not going to cover your bills, let alone if you have medical bills on top of it. You get cancer and you have to go through chemo and surgery and all these things that debilitate you and you're unable to work. Chemo gives people brain fog in a lot of cases and makes them sick and ill, and they have to stay home, and it's awful. And during all that, they're not able to work. Now they've got mounting bills. Cancer treatments are extremely expensive, and they're bringing in 60% of what they did before. That sucks, right? Yes, it does suck. I'm not going to lie, it sucks. From that perspective, it just sucks. The reason why they do this is because if they give employees, most people, let's say 90% or 100% of their pre-disability earnings, people will never go back to work. They'll just stay disabled, and the incentive to get back to work is very low. So the insurance companies do what most insurance companies do, and they undercut as much as they can. Most insurance companies won't go over 66 and 2/3 of your current earnings. Some states like California are very generous. One way to get around this is offering the benefit when the premium is taxed and the benefit is not taxed. Getting 60% or 66 and 2/3% of your pre-disability earnings when it's getting taxed on top of it sucks. 66 and 2/3 of your current income, if you're getting that when you become disabled, and then on top of it, it gets taxed, you're looking at more like 50% of your pre-disability earnings. Versus if you can get the benefit tax-free, getting 60% or 2/3 of your current income tax-free gets us a lot closer to where we need to be to help make people whole in these difficult situations. As I said, the benefit percentage for short-term disability is usually 60% to 70%. Long-term disability is typically 50% to 66 and 2/3. And then state disability is usually 50% to 70%. Definitions matter. They really do. Looking at your contract, making sure you understand the key definitions of your contract is going to make all the difference. I talked about this with dental plans as well. I had a whole video about dental contracts and why are all your claims getting denied and what's going on and what some of the things I see out here when I am helping people process their claims, understand how their benefits work, or improve their benefits without spending too much more money. A lot of it is in the contracts. These policies that the insurance companies are issuing are basically contracts. They're written word that state a promise from the insurance company in black and white. One of the really important features of that are the definitions. I can say, oh, I'm going to cover you if you become disabled, but if my definition of disability is so narrow that a million things can happen and you still wouldn't be covered, you wouldn't get any benefit from it. For example, if I write you a policy and I say, hey, Joe, if you become disabled, I will pay you $10,000 a month. And you call me 2 weeks later and you go, I fell off a ladder and I broke my hand and my leg. I'm a roofer and I can't climb on a roof and make a roof anymore. And you say, that's not a disability. And you say, what are you talking about? I can't do my job. And I'd say, my definition of disability is that you can do any job. So can you do any job? Can you get on a phone and do customer service calls? You can use your hand and your ear. You can do that. So therefore you're not disabled because you're not disabled from anything. You're just disabled from what you know how to do. So that's what happens to people if they don't really understand what type of disability contract they're buying, and they miss this key point, which is the definition of disability. How are we defining disability? So there's ONOC and ENEOC, of which I just gave an example of. ONOC benefits are paid if you can't perform your job duties. They're more generous and expensive. These contracts are more likely to pay out because if you are a roofer and you fall off a roof, break your hand, you become disabled for 3 months because you had to have surgery, you can't work, you can't climb a ladder safely, you can't swing a hammer. Now you're disabled from your own occupation and the insurance company will pay out. Versus the ENEOC definition, which benefits only pay if you can't perform job responsibilities suited for your experience, education, and it's very broad. The definition for what type of job you can do based off of your education and experience, it means if you can get any job, if you can't get hired anywhere. These are really important points. And then also we get into the elimination period. How long do you have to wait until your benefits start to pay? We see 0-day periods, we see 7, we see 2 weeks. Those are very popular. because employers are trying to sync up with paid time off or vacation time. If an employee is injured and they go home, hopefully it didn't happen at work. So of course it didn't happen at work. If somebody was skiing and they fell down the slope and they broke their leg, they call their employer and they say, hey, I can't come to work on Monday. First thing you do is you put them on vacation, paid time off, 1 to 2 weeks. If they're still disabled after that and they get a doctor's note, the doctor says they can't return to work, that is when a disability claim can be filed. Usually paperwork comes from the doctor, the employer, and the employee has to fill out a form to qualify or to file a claim. Elimination period is simply, most people would probably call it a waiting period, a period of time before the insurance company starts writing you checks. An elimination period for disability onset usually starts between 7 to 14 days for short-term disability. And then long-term disability, the waiting period is usually 6 months to a year. Because during that first 6 months to a year, you would have the short-term disability contract or the state disability contract cover that first 6 months or the year. And then the long-term disability would kick in after that. You don't want them overlapping, or you want them overlapping as little as possible. And shorter periods cost more, longer periods are less expensive. Benefit duration. So again, short-term disability is usually 6 months to a year, and long-term disability is usually 2 years, 5 years, 10 years, age 65 or Social Security normal retirement age. State disability insurance is usually 6 months to a year. So what is SSNRA? SSNRA is Social Security normal retirement age. There is a chart from the government, from the Social Security office, that says what, based off of your birth year, when your Social Security normal retirement age is. Some people it is age 65, some at 66, some at 67, and so on. Another topic that comes up as we go through short-term and long-term disability contracts is the benefit amount. With short-term disability, you're looking at a weekly benefit amount, and in long-term disability, you're looking at a monthly benefit amount. Many contracts will insure you or all of your employees at 60% of their pre-disability earnings, up to $10,000 a month, which will likely be enough for most of your employees. However, you may have a subset of employees that make more than that per year, and if they had to come down to $10,000 a month, that would be a severe cut to their income. In these cases, we would look at separating out classes, making an executive class, sometimes an executive and a management class, all other employees. We may come up with a series of classes to make sure that everyone is captured, everyone is getting a fair amount, and we're maximizing the benefit without getting the premiums astronomically high. So we would look at the definition of disability. I've seen where ONOC and NEOC gets split up between classes. Usually the benefit amount is what gets split up between classes. And we want to make sure that they all coordinate, that all these benefits coordinate with short-term disability, state disability, long-term disability, and that they offset. Many of these plans will offset. If you have a short-term disability along with a state disability plan, you can have both at the same time, and they will coordinate. Most of the time, they don't pay on top of each other. They do what we call coordinate in the business. And what that means is, let's say you have a state disability plan that covers you at 50% and a private plan that covers you at 60%. When they coordinate, you're never going to get more than the richest policy. Okay, most employees think, oh, I have a plan that pays me 50% and I have a plan that pays me 60%. So if I ever get disabled, I'm going to get 110%. That's what I thought when I first started learning about this. And that is not at all what coordination means. This also goes for dental benefits, medical benefits, the whole thing. Let's say you have a plan that pays 50%. It's a state disability plan. And then you have another plan that pays 60%. The state disability, they're going to pay out first, and they're going to pay you your 50%. And then the secondary insurance is going to get it. They say, oh, cool. First insurance already paid 50%. So all I have to do, because we're coordinating benefits, is pay 10%. So the guy who's secondary gets off scot-free a lot of times or with a very minimal payout. So just keep that in mind. We want to make sure the insurance companies are aware of all the state disability plans and where they are and make sure that we're getting that premium offset. Everybody understands what coordination means. The employees are not going to get all of this at the first go. We really simplify this for the employees. It gets explained. At least bring it up so that they're aware and understand what to expect. Set expectations is the most important thing. All right, we have executive classes and splitting classes. When you have highly compensated executives max out the group benefits at $5,000 a month and the executives earn more, insurers allow a carve out or a separate class or even a separate policy with higher maximums, sometimes $20,000 plus per month. And ERISA non-discrimination, you do have to be careful anytime you do class out benefits. Make sure you're following all the ERISA rules, guidelines, and non-discrimination rules and testing. We've got benchmarking, salary grades, integration, and employee locations. So how are employers evaluating the design of their plans? They're looking at benchmarking, they're reviewing what other employers are doing. Most HR managers and recruiters and execs who are looking to grow their business are really interested in making sure that they're attracting, retaining the best employees they can. And they want to know what Bob's doing down the street. If Bob's headhunting their top employees or Bob won over an employee or a sales guy that we really wanted, and what's Bob doing? What kind of benefits is he offering? What's that ABC company doing down the street? Why are they getting all my people that I want to hire? And most of the time you can go in there and click around on their website and do a little reconnaissance and find out what's going on over there. Or if you hire someone from over there, you can always ask, what are they doing over there? What was great? Which didn't you like? What did you like? So benchmarking, comparing yourself to other employers, what other employers are offering, not just down the street, but also within your industry. And of course, consider the size. If you are a smaller employer, you're likely not going to be able to afford as much on benefits as maybe the bigger guy. Or if you're paying a lower salary, you want to make sure your benefits are really robust, or you're paying a higher salary and have smaller benefits. That's usually where we see these trade-offs come and go. And then we look at the different salary grades and tiers. We want to review the salary maximums, make sure everybody gets adequate coverage, nobody's left out in the cold on those benefit percentages and maximum payouts. Integration, so consider sick leave, PTO, workers' comp in your elimination periods. If you have PTO, maybe you have a very generous PTO policy and it's 3 weeks or 4 weeks in a year. You may want to have a longer elimination period. A 30-day elimination period would really cut down the rates a lot on a short-term disability plan. Employee locations, consider all of the different places that the employees live and work. When you're looking at the disability, it's going to be determined based off of where the employee lives, their residence, where the payroll is. Quarterly wage reports come from. If they're coming from California, if you have some California residents, that is certainly going to impact what type of short-term disability plan you get, or Hawaii or any of the other states we mentioned before. All right, so how do all these benefits work together? We did talk about this briefly, but short-term disability is the first step. If you have short-term disability, long-term disability, and your state disability, you're gonna file with your short-term disability carrier first. Most of these short-term disability carriers do have the ability to assist you in filing your state disability. If you are an insurer, you give a policy to your friend and you say, if you become disabled, I will pay $10,000 a month. And that person becomes disabled and they come to you and say, hey, I'm disabled. And you've agreed to coordinate with the state. Maybe the state's going to pick up $8,000 of that. You only have to pay $2,000. you're probably going to sit there and help them fill out the paperwork. There's an incentive for the insurance company to help the employee fill it out with the state to make sure that employee gets their benefits from the state first, and then the private short-term disability pays second. So the employees at first feel awkward in asking for help from their insurance carrier. But in this case, I strongly do encourage the employees and the members and the insureds to go directly to the insurance company because they are the experts. A lot of the people in the disability customer service and claims departments at the insurance companies are going to have quite a bit of knowledge as to how to file for state disability. So it starts with short-term disability and state disability. If you have short-term disability and long-term disability with the same carrier, it should automatically roll over if the claim goes longer than everybody wants it to, right? Most people don't want to be disabled. They want to get out of there as fast as possible. Most employees are gung-ho. They say, I'm only going to be out a couple of months. Sometimes things happen, complications happen, other surgeries happen. The disability may go longer than everyone expects. And in that case, it should roll over to the long-term disability contract, and there should be no break in the employee getting those benefits. It should be a fairly seamless process. Please check with your insurance carrier directly. If your short-term disability benefits are running out and you need to get on your long-term disability benefits, be sure to make that phone call and verify. In short, state disability and short-term disability kick in first for the first 6 to 12 months. Once that runs out, it matches up with the elimination period and the start date of the long-term disability, and then the long-term disability goes for the duration of the disability. If eligible for short-term disability, state disability, long-term disability, workers' comp, the benefit amount is usually reduced by those payments to prevent double dipping. So if an employee gets injured at work, they start collecting from workers' comp, that is considered income. So anytime any income comes in, that is going to offset the benefit that you receive from short-term, long-term, or state disability. That's all I had today. Hopefully you found that useful. If you have any questions, comments, please put them down below. Like the video, share it with an HR manager, CEO, CFO, somebody that you would think would find this useful. I also do have a link down below to a free assessment, a free meeting with me, and I look forward to seeing you next time. Bye-bye.